Most people believe a high salary means financial progress. But in reality, a salary often does the opposite. It creates stability without freedom. You wake up early. You work hard. Your income increases. Yet somehow, your financial stress never disappears. Your bank account grows slowly, if at all. Your obligations grow faster. And the most uncomfortable realization is this: the system doesn't fail when you stay dependent on a paycheck. The system succeeds. Modern employment was designed to produce consistent productivity, not personal financial independence. Your salary provides comfort, but comfort is not the same thing as wealth. It creates the appearance of progress while quietly limiting how much freedom you can actually build. This is what many economists and financial analysts call the income dependency cycle. A system where your time is continuously exchanged for income while your expenses expand just fast enough to keep you tied to that income.
The result is a financial pattern experienced by millions of professionals across the world.
Yet you feel financially stuck.
Understanding why this happens is the first step to escaping it.
Because once you recognize the structure behind the salary trap, your approach to money begins to change completely. Strong intro: why hard work alone doesn't create wealth. For decades, the standard financial advice has been simple. Study hard. Get a good job. Work consistently. Climb the career ladder. On the surface, this path appears logical. Stable income reduces uncertainty. Regular paychecks create predictability. Benefits and promotions appear to signal progress. But when researchers study long-term wealth creation, a different pattern appears. According to data from the Federal Reserve Survey of Consumer Finances, the majority of wealth in the United States is held through ownership of assets such as business, equities, and real estate, not through salary income alone.
Source: Federal Reserve Survey of Consumer Finances.
Salary provides income. Assets create wealth. That distinction is critical. Assets can generate value whether you are working or not. This difference explains why many professionals earning strong incomes still feel financially constrained. Income supports a lifestyle. Wealth creates freedom, and the modern salary system is exceptionally effective at sustaining lifestyles.
Housing payments,
Transportation costs, insurance, subscriptions, taxes. Individually, these expenses feel normal. Collectively, they form a structure that keeps the average professional financially dependent on their next paycheck. This is not necessarily a conspiracy. It is simply how the economic system evolved. Businesses need consistent labor. Banks need borrowers.
Markets need consumers.
And salary earners provide stability to all three. Main Body, Part 1. The reality of the salary system. To understand the salary trap clearly, we need to examine how money moves through the system. When someone receives a salary, it rarely arrives as fully usable capital. Taxes are deducted immediately. In many developed economies, income taxes alone can reduce take-home pay significantly. For example, in the United States, federal income tax rates range from 10% to 37% depending on income level. Source: Internal Revenue Service, IRS tax brackets. After taxes, the remaining income flows directly toward necessary expenses.
housing is typically the largest.
According to the U.S. Bureau of Labor Statistics Consumer Expenditure Survey, first household tray, often accounting for a large expense category or more of total spending. Source: Transportation follows closely behind. Car payments, fuel, maintenance, and insurance can represent a significant portion of monthly budgets. Then come recurring services. Phone plans, internet, streaming platforms, software subscriptions. None of these expenses individually appear excessive. From a psychological perspective, this process produces what behavioral economists describe as mental accounting. Mental accounting occurs when individuals treat money differently depending on how it is categorized or distributed. Behavioral economics research.
When expenses are fragmented into smaller payments, the total cost becomes less visible. Instead of seeing one large number leaving your finances, you see dozens of smaller transactions. The brain processes these differently.
As long as each individual payment feels manageable, the overall financial picture rarely triggers alarm.
This is why many professionals feel financially stable despite making limited progress toward wealth. Their income sustains a comfortable lifestyle.
But comfort does not necessarily translate into financial independence.
Smart money versus retail behavior.
Financial markets operate under a similar dynamic. In trading, the term retail participants refers to individual investors and traders. Institutional participants, often called smart money, include banks, hedge funds, and asset managers controlling large pools of capital. These institutions operate with different priorities. Retail participants typically focus on price movement. Institutions focus on positioning.
Retail traders react.
Institutions prepare.
Retail participants often chase opportunities. Institutions construct strategies based on risk control and long-term capital growth.
The same contrast appears in personal finance.
Many individuals focus primarily on increasing income.
Strategic positioning does. Salary growth alone rarely produces financial independence.
Risk management and emotional mistakes.
But strategic investors focus on building systems that generate additional income streams.
One of the most common financial mistakes professionals make is assuming that higher income automatically solves financial problems. In reality, higher income frequently introduces new financial commitments. Economists describe this phenomenon as lifestyle inflation.
Lifestyle inflation occurs when spending increases as income rises. Instead of creating larger savings gaps, income growth often leads to upgraded lifestyles.
Larger homes, more expensive vehicles, frequent travel,
Higher monthly obligations.
Research from the Journal of Consumer Research shows that individuals tend to adjust spending habits upward as earnings increase.
Get a benzune.
This dynamic can quietly eliminate the financial advantage created by salary increases.
Without intentional financial planning, income growth simply supports a more expensive lifestyle.
The gap between income and expenses remains small. And that gap is what determines financial freedom, not salary size. Not salary size.
Strategic positioning for long-term wealth.
Escaping the salary trap does not require abandoning employment. Escaping the salary trap does not require abandoning employment. It requires changing how income is used. Instead of allowing income to expand lifestyle obligations, strategic earners create separation between lifestyle and wealth building. This begins with controlling the financial gap.
Income minus expenses equals available capital.
That available capital becomes the engine for wealth creation. Historically, individuals who build significant wealth tend to allocate a portion of income toward productive assets. These assets may include equity investments, business ownership, real estate, intellectual property, automated digital systems. Each asset class has different risk characteristics.
Assets generate value.
Income supports consumption. Another factor increasingly shaping financial strategy is technology. Artificial intelligence, automation, and digital platforms are rapidly transforming productivity. According to a report from McKinsey Global Institute, automation technologies could affect up to 30% of work activities globally by 2030.
Source: McKinsey Global Institute.
This does not necessarily mean jobs disappear, but it does mean the structure of income generation is evolving. Individuals who rely entirely on a single salary may face increasing economic uncertainty. Those who build diversified income sources gain flexibility. Skill stacking also becomes increasingly important. Instead of specializing in one narrow capability, many successful professionals combine multiple complementary skills. For example, finance knowledge combined with data analysis, marketing combined with technology,
Trading combined with risk management systems.
This layered skill approach allows individuals to create opportunities beyond traditional employment structures. Psychological shift. Structure is rare. Working harder increases income. Working strategically increases freedom. Emotion reacts. Systems respond. Motivation rises and falls. Discipline compounds over time. Income feeds a lifestyle.
Assets build independence.
Comfort feels safe. But growth often requires controlled discomfort. Most people chase promotions. Few people build systems. Most people increase spending. Few people increase ownership. Markets reward patience. Money respects structure.
And the individuals who understand this difference begin playing a completely different financial game.
Power outro.
The salary trap is not about employment itself.
It is about dependency. A salary can be a powerful financial tool,
But only if it is used strategically,
income should create options.
not obligations.
Financial independence does not come from earning endlessly higher salaries.
It comes from gradually reducing how much your life depends on that salary. This shift changes everything.
You negotiate differently.
You take smarter risks.
You invest with patience.
And most importantly, you begin building systems that generate value beyond your time. This is not gambling.
This is calculated financial positioning.
Understanding money is not about chasing quick wins. It is about recognizing structures most people never question.
Because once you see those structures clearly, you gain the ability to move differently. And when you move differently,
Your financial future starts to change. The market trends confirm our strategy. We hold steady, projecting controlled growth ahead.
welcome to Finance Hustle.